you didn't wear a hat into the studio this morning because you'd be running it down the street, Danny. But a lot going on. There's no question that the S&P 500 had a record close yesterday afternoon, and that is on the heels of a higher inflation report, a number that we haven't seen since 1982.
Yeah, I think it's fair to say the market was expecting it. It came in at 0.5% in November, up 6.8% over the last 12 months, the largest jump since the year the Brewers were in the World Series.
Exactly right. But that is, you just nailed something. The fact that it hit the expectation number, and sometimes it's not the number, it's the expectation, and that's a really good point.
Right, and the other thing, we've talked often about the persistence of inflation, and we're starting to see, the rent element, which is 30% of CPI, start to contribute to CPI. That was up 0.5% as well, up 5% year over year. And we expect that to continue because rental prices typically lag increases in home prices, and anyone who sold a house recently knows that the housing market is very strong.
Yeah, so let's talk about inflation just for a second, because there are parts of it, you and I have been talking about this for nearly 6 months, that we would almost chuckle when we said transitory because it didn't make any sense. And of course, last week, the Fed Chair Jay Powell said that he is going to retire the term transitory because obviously it is not going to be transitory. It's not going to work its way through quickly as expected. But you look into inflation numbers, and parts of it, obviously, that the oil and gas and filling up your car, that is obviously higher. Going to the grocery store is higher. Of course, beef price is up 20%. But the other parts that I want to pay attention to are the parts that are stickier that could benefit your portfolio.
Right. Well, when you see, companies that are able to pass along prices, whether it's a Costco or a basic materials company, that leads to higher earnings and ultimately higher share prices, more buybacks, increases in dividends, and so on. So good things. And what we've seen historically is stocks actually perform fairly well during periods of inflation, provided it doesn't get out of hand, which we do not expect it to.
Well, and we're going to look into next year. And then there's this thing that we look at is, what is the Fed going to do? Now, we think next week when the Fed chair speaks, he's going to talk about accelerating the taper process. Now, that sounds complicated, but it really isn't.
No, he's just going to take the punch away from the party a little quicker than people had thought, which will leave a few people unhappy, of course. And that's really just reducing the level of accommodation they're supplying the system. It was $15 billion a month. Maybe they increase it to $20 or $25 billion, and the more they increase it, the sooner they'll be done. And it's only after they're done that they will consider hiking rates, because that's the key element. When are they going to begin raising rates? Because historically, even after the first rate hike, the stock market is typically up 6% on average. So you don't want to necessarily run for the hills when the Fed raises rates, but you certainly have to think about your portfolio from a tactical perspective.
No question. So 2022 is upon us. And of course, if they accelerate the taper, which means that at some point they're going to stop buying bonds in the open market, that probably puts us around March of next year. And then there is this betting site that we look at that talks about, could they raise rates? And some are between 60 and 80% that we're going to see rate hikes in the second quarter of 2022. So there's no doubt we're going to have to pay attention to that.
That is certainly that's true. And the nice thing too, as we close the year, we're nearing the Santa Claus rally mode. Typically, the market rallies from the beginning of December into year end and on into early January as pension funds fund their equity holdings and so on and so forth. So there is a lot of tailwinds driving the market right now. One of which is that people still don't really believe in it. I mean, there have been a lot of money has gone towards equities, know all about the meme stocks, but the flows to international equities surpassed the flows to U.S. stocks, despite the fact that U.S. stocks have dramatically outperformed.